I think there's a very good chance we're going to end up in a deal. And so we're giving it 5 days, and then we're going to see where that takes us.
President Trump speaking after he postponed his threat to hit Iran's energy infrastructure, saying negotiations are underway with Tehran. You're watching The China Show. I'm Yvonne Man with David Ingles.
Yep, markets are trying to figure out noise from signal as we count down to the open up markets in Greater China. Let's get to your top stories today. Oil prices are holding up most of this steep drop, but from the cutoff, as you can see, we're up now, in fact, about 2%. You did have, of course, here the president there, the decision to drop his deadline on Iran. Chinese stocks are set to join a rally in the Asia-Pacific after the CSI 300's worst day in nearly a year. Also on the program, Australia and the European Union cap decades of talks with a new free trade deal, cutting tariffs on a wide variety of goods. And Apollo stock falls in late trade as the company curbs redemptions from one of its private credit funds. It's the latest alternative asset manager to grapple with a surge in withdrawal requests.
Wild seems to be normal these days when it comes to the whipsaw that we're seeing across markets there. Really, the news of President Trump postponing his sort of deadline when it comes to those threats about attacking power plants from Iran, that certainly did help lift the risk sentiment. You saw oil drop some 10% over 5 minutes on Wall Street. So a key question really is what happens up until Friday, right? Are we really going to see some negotiations? I think we're hearing from the Iranian side this morning, and they seem to be painting a much different picture. Yeah, it's not a completely different picture, yes. In fact, right? When you look at the rhetoric coming through, it literally depends who you ask. Is there a date that's going to be taking place? I think the latest line we've gotten from the Iranian side is that no, they are not looking to have any negotiations with the U.S., although when you look at the CBS report, which is somewhat in the middle, in that they are looking, the Iranian side is looking at some messages through middlemen, in as far as what the U.S. has asked. It seems that the U.S. has reached out. Yeah, and you got to wonder, are we still facing some doubts about, is this deadline just something that prolongs the uncertainty? Are we really getting closer to some sort of deal? I think we got to keep asking those questions up until we get to that point. But then again, you have headlines from the journal talking about the Saudis are considering whether to actually join in this war, and certainly that does lead to a lot of questions on how easily can President Trump exit out of this war? Can it be as easy as he started it? Yeah, and is it his decision solely? Yes, too, right, to be able to do that? And the other complication here is that I think the last 1 or 2 times President Trump said things were warming up in terms of negotiations, then they went and struck Iran, of course. So there's also that. Is this just a bluff amidst everything else that's taking place? And also keep in mind, right? There's this carrier group that we understand is making its way from the Asia Pacific into that part of the Middle East. So lots of things to consider given the complexities of war. But yes, President Trump did say that Tehran is keen, according to him, to make a deal here. In fact, let's have a listen to what the president had to say there.
They want very much to make a deal. We'd like to make a deal, too. We're going to get together today by probably phone because it's very hard to find a country. It's very hard for them to get out, I guess. But we'll at some point very, very soon meet.
Right, and I think this first board that you're going to see on your screens just underscores the confusion markets are undergoing right now. It's very rare you see stocks, oil, and the dollar moving in one direction. Relief rally across equity markets today, or as I speak. The dollar is catching a bid on the back of some of the pushback from Iran, and oil as well on the latter. U.S. futures coming up on your screens. You have the Kospi Index, Nikkei. You have Taiwan coming up at the bottom, coming online 1.5%. U.S. futures are now down, in fact. The dollar story is playing out across EM markets, where you have the Philippine peso is a very good example of a currency that's really lost favor. And the peso is back below that 60 handle. We did hear from the Energy Secretary a few minutes back talking about how they have effectively just over 40 days of oil supplies left. The big move overnight What's interesting, because this time, as of the close yesterday, massive move down in the CSI 300, 3.3%, somewhat split the difference overnight with the ETF just down about 0.7%. Xpong EV is very much in focus today. We'll get to the earnings and everything else corporate in a moment here, but we are set to join the rally across the Asia Pacific. Coking coal futures also did see a massive pop yesterday. This is really also on the back of the energy story, 1.5% in Dalian.
If I'm continuing to see supply disruptions in LNG and the like, it seems like Asia is really seeking coal as that sort of alternative source there. So certainly that's one thing to watch. We're going to get the likes of Towngas coming on too about how they are dealing with, of course, all this volatility. For more on the Iran conflict, let's bring in our politics editor, Laura Davison. She joins us now. First of all, we got to ask the big question, right? Is this really talks about some deal that's going to materialize, or is this more just about pushing the uncertainty?
So there's certainly been a lot of speculation that this is Trump, sort of trying to do a head fake here. Both, allies, at the America First Policy Institute, a think tank in Washington, have speculated that, as well as the Iranians have vocalized that as well. But it's clear that there's at least some sort of rumblings, though probably not as much as Trump has suggested. There are substantive policy talks. There are, key points of agreement. U.S. officials have conceded that there are, sort of back channeling that's happening. There have been outreach from both sides going through intermediators in the region, but there are not robust talks. This 5-day timeline that Trump is talking about to reach some sort of deal, highly unlikely. In some, in fact, have even speculated that, in fact, the talks that are setting up are going to be long, arduous talks, not unlike what President Barack Obama did to get the Iranian deal back a decade ago that Trump threw out. The end game here may be ultimately something similar to what Obama struck, in 2015.
And, what would have been the deadline would have been about an hour and a half back. What spurred the president from backing down, to back down from that ultimatum that he gave?
According to diplomats and others who were talking with him, one of the big causes here was the market reaction in Monday in both Europe and Asia, just seeing the equity markets fall, the price of oil skyrocket, treasury markets also getting a little wobbly as well. That is a key indicator for the president. It was unusual to see him come out and speak so early in the morning. He came out about 7 a.m. U.S. time. Yeah. He almost never comes out at that time. He starts his day a little bit later. He likes to speak more in the afternoon and evening. So the fact that he was out there before market open signals that the market consequences here were a huge portion of this.
Yeah, I think the market was listening too. Certainly that the message was clear that he's eager to exit this war. But tell us a bit more about the Strait of Hormuz. There's talks of this joint U.S.-Iran custody of this waterway. What would that look like?
This is one of the more far-fetched things that Trump has talked about. He said that, perhaps he and the Ayatollah, whoever that is, Trump said, they could jointly control the Strait of Hormuz. That is almost seemingly a non-starter, both just from Iran agreeing to that, and two, what would that even look like? Suddenly you have, the Iranian Navy, what's left of it, and the U.S. Navy jointly patrolling this. That seems, almost impossible. But this is, Trump likes to sort of throw out some of these far-fetched ideas. Remember a couple weeks ago, he was talking about he might be able to pick who the next leader of Iran might be, quickly moved away from that. We'll see if this has legs. If he's still talking about this in a week or two or three, there may be some kernel of truth or, kind of reality there. But otherwise, this is looks like more Trump wish casting what he would like to see happen.
That is very strange, if I have to say so myself. It's almost like joint custody amidst a more than acrimonious divorce. Anyway, okay. Anything is on the table, I guess. Laura Davison, fantastic. Thank you so much, our politics editor there. As markets try and digest and distinguish signal from noise, let's get a sense, really, of what we should be doing with all this information short term. Winnie was here with us on set, head of APAC Equity Strategy at BofA Global Research. I don't envy your job at all. What questions are you getting from clients, and do you have any answers to those questions?
I think the question we're getting are all over the directions, right? Ranging from the geopolitics, President Trump and Xi's potential summit getting delayed, to energy prices. What does it mean for the economy, for the market, for different sectors? Yeah, every direction.
And how do you kind of? I'm just wondering, because it seems like the market fallout it's changing day to day. But are we entering this new phase now where initially it was the concern over inflation, and now is it potentially now a growth hit to the economy?
Yeah, I think, what we've seen in the past 3 weeks is increased volatility, right? We've seen Kospi down 12% in the day, up 10% the next day, right? We've seen some of the very crowded position, even if fundamentals were fine, got sold off, right? Ranging from Korean memory to gold to China small cap stocks. And I think increasingly markets start to price in a prolonged inflationary, or not calling it an energy crisis, but prolonged pressure to inflation and growth. So even, last week in our Taiwan Asia Tech Conference, investors were very bullish on the AI cycle, demand very strong, supply bottleneck, but nonetheless, there is still this overhang of what if energy prices leading to higher rates, less liquidity, potentially amplify the private credit crisis and leading to a macro-driven AI demand correction, right? So I think, increasingly investors start to pricing in a more cautious scenario for rates, liquidity, for growth, and increasingly people realize the importance of diversifying positions because this persistent, volatility, high volatility may actually persist, right, with the low visibility on how things will be going. Yeah.
As we come out of this, and hopefully very soon, in what way do you think the growth and earnings outlook has changed? Given, let's say, we've been in this for, let's say, a month. How does that change the degree of the trajectory on the back of it?
Yeah, I mean, I think IMF gave some data, right? $10 higher barrel Brent price lead to 10 to 20 basis point lower growth and adding to inflationary pressure. So there is clearly that broad macro concern. But I think importantly is different country will face different pressure, right? So relatively speaking, within this part of the world, China might not be the most exciting story on growth, right? Partly because it's so big, so diversified, it still have the legacy challenges. But on the other side, in the sort of stress scenario, in the worst case scenario, China relatively stack up well because it's been preparing for the self-reliance, self-sufficiency on energy, on food, on supply chain for years. And China have a large domestic coal reserve. China has more diversified energy supplies being developing renewable new energies, and also China has a big Brent oil reserve inventory, right? So relatively speaking, in the past 3 weeks, you saw that, U.S. relatively outperformed by falling less. China actually also outperformed, right? CSI 300 or HSCI in the first 3 weeks of March was down like 5 to 7%, whereas most of Asian market were down 10 to 20%. So I think, we don't know the absolute, right? What will be the stabilized new norm of oil prices, but we at least can have some visibility on the relative resilience across different markets.
There has been rotation within the Chinese market as well. I think they're away from the sort of the growth plays to more income. I'm going back to the banks, and maybe those are the defensive plays, right? Is that something that you would recommend at the moment too?
Yes. In fact, in our year ahead, for the whole year, our strategy has been barbell, right? Because we are less convinced about another, 20% multiple re-rating, so to speak. So we've advised people to play both end of the strategy. And indeed, in March, we've seen energy, banks, utility relatively outperforming, auto as well. On the other side, it's the material sector down like over 20%, right, because of the crowded long. So I think, the risk further, just to reiterate my earlier point of the value of diversification, right? And in China, I think the downside protection remains to be very important.
Okay, Winnie, we have more from Winnie Wu there, head of APAC Equity Strategy at BofA Global Research. She teased a little bit about this Asia Tech Conference here, really talking a little more about the AI shockwaves and really where are the sectors that are going to be benefiting or maybe seeing the most disruption. We'll have that coming up in the next segment there. Of course, we're counting down the open of trade in Shanghai, Shenzhen, and Hong Kong. There is a relief rally underway here in the Asia Pacific here now that we seemed like when it comes to this deadline, we have been pushed back by a few days up until Friday. Futures are pointing positive this morning. This is The China Show.
Right, welcome back. You're watching The China Show. I think the latest AI iteration in at least the Chinese market, specifically last week and a half, has been sort of open claw. 30,000-foot view from BofA Global Research. Obviously, demographic pressure, AI disruption, very complicated graphic. We've struggled to actually put this together. We did, though. So hats off, of course, to our graphics team here. Winnie, of course, is here with us still on set, the author. And if you had to send a postcard to thank for this graphic, it's Winnie and her team. Explain this to us, Winnie. What's the takeaway from this?
So essentially, this is putting the 20-something different key sectors and their MSCI into a 2x2 matrix. The horizontal axis is aging population, the beneficiaries and losers. So relatively speaking, on the right-hand side, aging, shrinking population is relatively positive for the demand of like healthcare, insurance, pharma, diversified financial services, as well as semis and capital goods, because that will increase the demand for automation, robotics, right? Whereas left-hand side are the sectors relatively unfavorably positioned for aging population. That will be, the consumer discretionaries, the autos, even the real estate. The vertical axis is our assessment of the real moat against AI. That's based on REAL, so-called regulatory critical, all right? E for enduring cycles, A for asset heavy, and L for local services. So on the higher part of the graph, like the utilities, telcos, energies, real estate, semis, those are sectors that stack up relatively well against the real REAL framework. Whereas the lower part of the graph, the media entertainment, diversified financials, the softwares are relatively more sensitive to the AI disruption. So based on this matrix, what we say is the top right-hand side corner, which are better positioned for both AI resilience and aging population, the healthcare, semis, capital goods, are probably the structural opportunity for investors. Whereas the bottom left-hand side, the more software, internet-related space could be more vulnerable for persistent derating as AI getting smarter and more capable of replacing these sectors. But having said that, we want to emphasize that even in these like soft sectors, internet software, they are still relatively valuable because many large platform companies, the individual company would have relatively high real moat, right? Some big internet platforms in China operate systematically important telecommunication and the financial payment function, right? So even in this challenger sector, we say there are relative winners. People can do, the pair trades to generate alpha.
You said this is the real, as you mean, REAL, regulatory enduring asset local. You say right now investors are rushing into the halo sort of trade. Explain why that's not the right strategy now.
Yeah, I think Halo is probably a bit more U.S.-centric.
Heavy assets, right?
Yes. But in Asia context, especially in China, heavy asset has no scarcity, right? We think of steel, cement. Exactly. We have all this overcapacity, right? So in capacity-rich countries like China, Halo doesn't necessarily work. And in fact, if you're tied up with these heavy asset, long-cycle industries without the regulatory mode, you might face more liabilities, right? Facing all the overcapacity, long-term deflationary problem. Also, on the other side is local services, right? When we think about hotels, restaurants, healthcare, even IT services, they are not necessarily heavy asset. They are not Halo. But in the short term, it's very hard for AI to replace them, partly also because in US, labor cost is much higher than in Asia. It's still much cheaper and much more pragmatic to use skilled laborers rather than deploy large scale of humanoid robots in these settings. So that's why we think the REAL framework probably works better in the Asian context than Halo.
Okay, I think it's the first time we're speaking to you too, ever since the open claw phenomenon became more widespread. It's not as if it wasn't around 2 weeks ago. What is the implication going to be on earnings? Let me just ask the direct question.
Okay, so for the near term, for some large internet companies, it probably means they are stepping up, catching up on investment in AI-related, whether it's computing power, cloud, or talent.
Okay.
So short term, it might actually be earning negative. But on the other side, I think multiple also derated, right? If you look at the underperformance of China year to date, it's mainly because of Hansen Tech, right? A lot of it is more multiple derating than earnings reduction for some of the companies in the media sector. So multiples to some extent already reflected that, and I think for these large platforms, they still offer very important optionality. So if this OpenClaw, if their next generation of LLM can have something exciting, I think their ecosystem is still very valuable and hard to be replicated. And as mentioned earlier, some of these companies actually have high regulatory moat. It's not any new AI startup can replace the fundamental payment infrastructure in China, right? So we still think there are significant value in terms of accumulating these good companies on the lows.
Winnie, it's great to have you. Winnie Wu there, head of APAC Equity Strategy of BofA Global Research. Your pre-market in Hong Kong is just opening up here, and we continue to see them joining in this relief rally. We're 1.5% up on the Hang Seng, getting closer to 24,760 or so. Futures are up 0.8%, and the weaker renminbi here, we're sub 689 right now. But yes, we'll have more coming up. This is Bloomberg. Watching, of course, in your agenda today, the turnover that we've been seeing yesterday was certainly a pretty interesting one. When we saw HSI turnover was the second highest this year. We'll see if we get another day of this as well. Given this relief rally, and certainly there seems to be pretty positive when it comes to what futures are pointing to here today in mainland China. Watching ETF flows in particular, there is going to be a CGB sale. We are going to be heading to the BofA Forum coming up here as well. And there is the Wealth for Good Summit in Hong Kong, where Dave just spoke with Christopher Hui about the opportunities lining up for Hong Kong to really, in some ways, capture, I guess you could say, the wealth and the like that's coming from the Middle East, given some of this volatility that we're seeing, and of course this Iran war. What else are we tracking there?
Yeah, it's an opportunity, I think he said.
Yeah.
The fact that you have Hong Kong as fairly stable, they are putting some structural reforms in place. In fact, we'll play the tape about later on.
Yeah.
He talked about how they're going to file a bill with LegCo that incentivizes from a tax incentive cross assets. So a lot of that's going to come up as well. It's the non-sexy stuff, but as we just talked about earlier on, it's the non-sexy stuff that pays off when things get overly exciting, too exciting to the downside. It's really this period of stability that you look for. And are we going to get that, though, as far as the earnings story goes, is the other point we want to bring up, too, here. So Xiaomi's coming out with earnings today. We talked about Coke and Coal and the pop we're seeing there specifically. Some of these stocks we're tracking, too, going into the open today.
Yeah, Laopu, Wuxi, Abtec, Henderson Land, WeRide are the ones to really track here. And when it comes to Laopu Gold, there you go. We're up some 10%. Given that it was a profit beat as well, of course. We're also watching what gold prices have done in the face of this sort of whipsaw across markets here. We've got the open coming up next. This is Bloomberg.
Welcome back. You're watching the China Show. We're counting down to the open of markets. So we are set to join this relief rally across the Asia Pacific. The coming, if not present, current complication is well, for one, the dollar is back up. U.S. futures, European futures are down. As more headlines are coming through, it's not as straightforward as President Trump has suggested, that there is an off-ramp and that everyone else is on board with that plan.
The de-escalation doubts are trickling in a little bit that, is this really just posturing from President Trump? Is there really signs of them working towards some sort of deal that could lead to that off-ramp? As Dave mentioned, right, when you have headlines from the journal saying the Saudis and even some Gulf nations are considering joining in this war now, it certainly does raise a lot of eyebrows here on whether there is an exit strategy. So that's in the background. But then again, you are still seeing a bit of a catch up here in terms of this relief rally in onshore markets. And you're seeing CSI 300 is up close to 1% here this morning. So certainly stock investors are really kind of tuned to what President Trump said, was that it seems like he's eager to end this war. So certainly that's one thing to watch. You see Shanghai crude futures are also cooling down a bit here by about 4.5%. But yes, as Dave mentioned, right, during the Wall Street session, we saw a 10% decline of oil prices after what we heard from President Trump. And now we're coming back up just slightly here as well. U.S. futures, as he says, still in negative territory. So that is one to watch very closely. Let's take a look at how Hong Kong is looking like here as well, because there certainly is going to be a lot of earnings to talk about as well. HS Tech is actually catching a bid here, so 1.5% up. Hang Seng is back to 24,800 levels here today, but you are seeing a bit of recovery in some of these tech stocks that we're seeing up about 2% for Alibaba, Meituan, Tencent as well. Offshore RMB is sub 690, so certainly the cooling of the dollar certainly was what we saw overnight as well. Certainly what we're seeing when it comes to the earnings side, and we'll watch how oil stocks perform, because are they going to take a look at what we saw overnight? And yeah, mostly it seems like we are heading lower here, following what we're seeing with the oil price. PetroChina, CNOOC are lower by about 1% to 2% here right now. Coal stocks, that's been hot. I mean, in the face of all these supply constraints around LNG and the like, what you're seeing here in the region is this sort of people are turning and trying to secure alternative sources, right? And coal seems to be the beneficiary to all that here. But right now, some of these coal stocks are coming off some of the initial moves that we've seen in the last few days or so, maybe because of some of the good news that we're seeing, I guess, in terms of what we heard from President Trump, kind of pushing this deadline of whether to attack power plants in Iran to Friday now. We were supposed to talk about just now, around this time, that deadline was supposed to expire today. But yes, we've been pushed back by a few days. Gold stocks, that's going to be the interesting one, right, given the volatility that we've been seeing with gold prices. We have seen here in the Asia session, gold prices are heading lower this morning as well. So you've got to watch what happens with some of these miners and the like, because we did talk about Laopu Gold. That's certainly one thing to watch, right? That stock is up some 8%. It's not just because of the gold price, but really what they saw in terms of the earnings side of things, right? Yeah. So it was a prelim beat for the first quarter. Of course, though, the key question is, what are the jewelry sales going to look like here, given just the rapid whipsawing that we're seeing with gold prices moving forward? Yeah.
That's really because gold has really acted like a risk asset, behaved like a risk asset of late. So does that change the allure of its quiet, stable embrace? Yep, there we go. We're up 10% for Laopu Gold's full year revenue. Yeah, profits also soaring. They have jewelry surging in Hong Kong, of course, amid the popularity. And obviously, keep in mind, the earnings story and the report is context from what was really a fantastic year and past calendar quarter for the gold story. Let's bring in Min Lo, our China correspondent, to tell us why Laopu Gold is leaping like a lauhu, like a tiger. Anyway,
yeah,
sorry.
It certainly has been performing really well last year. We're talking about more than doubling of its revenue and net income, 220% gain on revenue on year for the full year, 230% gain on net income. And a lot of it is driven by, of course, gold prices. Gold jewelry is still seen as an asset rather than just a discretionary spending in China. Of course, the big question is what happens this year, right? Because we did see gold prices come down. But the good thing for Laopu Gold is that they sell their prices at a fixed price, so it's not tied to gold. And they also routinely hike their prices 2 to 3 times a year. So that cultivates a very loyal pool of customers, because they are assured that whatever they buy, the value of it would be preserved and would keep increasing. And every time before the price hike, there will be long queues of people queuing up to get their hands on the pieces before the price hike. And there is also increasing evidence that there's growing consumer overlap with the other Western premium brands, the likes of Louis Vuitton, Cartier, Hermes, and so on. And also, this company has really proven itself in being able to command a premium, because its latest price hike is its biggest yet, about 27% on average, according to Citigroup. Of course, a lot of it is also to do with its heavy investment into expanding its retail footprint, because it opened its first overseas store in Singapore. It finally achieved a presence in every single one of the top 10 luxury malls in China as well. It's upgraded its storefronts, so all of that contributing to that momentum for the company.
Yeah, it certainly is reflected that in the stock. Talk about Country Garden, because they just came up with earnings and they're seeing a return to profit as well. What sparked this sort of turnaround for the company?
Yeah, this is quite a turning point for the company. It's been a 2-year journey to restructure its debt, and the company says it's expecting between 1 to 2.2 billion yuan in profit last year, coming from the non-cash gain after it completed the restructuring. But without that non-cash gain, though, they said that they will still be making a loss because of the profit margin crunch in the property sector. So not fully in a healthy state, but still it looks like the light is at the end of the tunnel. And according to our Bloomberg economics team, in terms of the property crisis, according to Eric Zhu, he says we're about 70% to the finish line. So 30% to go. And that means perhaps by 2027, that is when we could see the trough of the housing market and the stabilization there, which means from the peak of 2021 to the trough of 2027, it is a 6-year period to really normalize the property sector in China.
Okay, very quickly, Xiaomi's out today.
Yes, Xiaomi, we are expecting the slowest growth yet since 2023. We're talking about less than 7% in revenue growth. This is compared to double-digit growth in the last few quarters, 20 to 30% growth in the last few quarters. So quite a big decline there. A part of it is because of the memory chip shortage, which is pushing up prices. That's weighing on its margins, especially on the smartphone side, because it's already priced very competitively compared to the likes of Apple and Huawei. So it's a low margin business for them already. And then when it comes to the EV sector, yes, we are looking at very strong demand in terms of shipments. We are looking at some analysts saying possible upside surprise when it comes to the delivery target. But again, there is the material price increase as well. We did see with the launch of the SU7, investors selling off the stock because of concern that it's hiking its prices at too slow a rate to compensate for the rise in material prices. So again, that's going to weigh on the margins as well.
Okay. Out with earnings today, Xiaomi, Min, thank you for the preview and the recap, of course, of the others that we just talked about there. The dollar index, we talked about this. This is your risk gauge today and where this goes. And as you can see, we've picked up ever so slightly from the lows a few hours back. Hence explains why we are still seeing a rally in the region and why we are also seeing this rally come off highs of the day as we speak.
Yeah, there's conviction, but less. It's fading a little bit, I guess you could say. But yes, at least for now, we're seeing an up arrow story here. Nikkei, Kospi are still seeing gains about 1%. Taipei, we're coming off already here, and we're just about 0.5% to the upside here as well. Coming up, we're going to speak to Hong Kong-based energy supplier Towngas about how the Iran war supply crunch is affecting prices and the switch to renewables in China. The managing director, Peter Wong, joins us next.
Right. Welcome back. So if you think oil prices have gone up, then look at gas, because gas has actually gone up. Last I checked, more, if not much more, when you look at global benchmarks. It also depends where you look, right? So several proxies in the U.S. Europe has certainly seen a massive upside. Some of the benchmarks we use, Platts, for example, here in the Asia Pacific, has also gone up quite substantially, given obviously what's been taking place in the Middle East, and as people scramble for options and alternatives given the supply chain issues there. Now, for more on what that is perhaps doing and changing the outlook for gas providers here in Hong Kong specifically, we're joined now exclusively by Peter Wong, Managing Director of Towngas. It's Hong Kong's only piped town gas provider. Of course, it's product produced locally from naphtha and imported natural gas, and we'll get to where you're getting your supplies in a moment. Mm-hmm. Good morning, and very nice to see you.
Yeah, good morning.
I wonder, people are wondering, they see a gas company and immediately will think how things in the Middle East are affecting you. Mm-hmm. If you could elucidate for us what direct or indirect impact you are seeing or expecting because of what's taking place globally.
Okay, thank you for having me here. The town gas that we manufacture here in Hong Kong in our Taipei plant in the New Territories, and the feedstock basically of two elements. One is naphtha, as you just mentioned. The other is natural gas. Right. And starting from the year 2006, before that, we've been using 100% naphtha to manufacture town gas. But starting from year 2006, we have a long-term contract with the natural gas supply in Australia. So basically the gas coming all the way from Australia and and it did not pass through the Middle East. So we should be gas supply should be safe. And also, this is a long-term contract. We call it take or pay contract. In other words, I have to buy certain quantity of natural gas. The supplier has to supply that quantity of natural gas to us at a predetermined fixed price. This is a 25-year contract.
Okay.
And the price was fixed in the year 2006.
Oh, that's coming up. Anyway, okay.
Yeah.
I want to share with you that have we not used natural gas since 2006? We continue to use naphtha.
Okay.
That means naphtha price are always up and down. And then basically since 2006 up to now, we save Hong Kong dollars 20 billion to our Hong Kong customers because the natural gas price was basic.
Yes.
Right? So this is a situation here in Hong Kong. Now, the supply from Australia should be continuous. Now, what about naphtha? Naphtha could be a different story because given the current chaotic situation in the world, in the whole world. But naphtha also comes from Asia. The supply, basically are all based in Asia. And we have the inventory, at least 1.5 months inventory on site in our Taipei plant. So basically, we will continue to manufacture the Towngas for at least 1.5 months. And then also, in addition to that, we have short-term contract for 3 to 4 months, which we already signed the contract and fixed the price before the war, right? Before the war. So basically, we were pretty sure that for the next 3 to 4 months, if nothing goes beyond our expectation, we should be safe.
Okay.
Right?
So
in terms
safer,
of supply and in terms of price.
Okay.
Yes, it's good that you secure some of these contracts already to buy you some time. But gas prices across the region are already surging. What sort of premium are you attaching to some of your forecasts now? If this prolongs to beyond 3-4 months? And is it something that you are going to have to absorb, or can you pass it on to customers?
Now, there are a couple of things we can do. One is, if, let's say, the war prolonged longer, and we can use more natural gas.
Okay.
I want to explain a little bit more on that. Currently, natural gas accounts for 60% of Towngas when we manufacture Towngas, and the other 40% is naphtha. We can edge up the percentage of natural gas to 70%. If there's a shortage of naphtha, we can edge it up because the natural gas coming from Australia
is secure.
Is secure, and the price is low too. So if naphtha the price shoots up, we can use more natural gas to protect our Hong Kong customers.
Okay. And how does it affect your earnings projections for the year? What scenarios have you gamed out for the company?
For the time being, we still take a positive approach, right? Nobody knows. It's really unpredictable what's happening. The conflict creating all these chaotic and unpredictable challenges. Right? So we monitor the situation very closely. We keep an eye on in particular, the naphtha supply. Right, so we will make sure that the naphtha supply will be safe.
What indications are you getting on the naphtha? Because that seems to be affecting not just you, of course. That is more, to your point, right? That's more market determined and moves on a more regular basis.
Right now, we can see the price edge up. That's for sure, because naphtha and oil, the price go hand in hand. Right, so edge up, but a bit, but not too much. As I mentioned earlier, we can use more natural gas in case if that happens.
You also have a JV in China, and you do provide some Towngas and renewable energy solutions there. What are you seeing in terms of this Iran war? Does it have any sort of impact, you think, on gas consumption in China? And does it only ramp up this whole sort of push to renewables that we're seeing?
Well, in the year 2020, central government already announced 2030, 2060 carbon peak, carbon neutrality. That was a very good strategy. So basically, the energy in China, 50% of which is import. Right? The central government foresee that. And so that is why more renewable energy will be happening in coming years. and that basically energy in its own hand is better than depending on suppliers. Now, we have 320 city gas in China. We have a total of 45 million household customers. Hong Kong is only 2 million. And so now, natural gas in China, they're coming from different sources. China has huge gas reserve in Xinjiang, in Inner Mongolia, in Sichuan. So that accounts for approximately 60% of the total consumption in China. And the other we got from Russia. We got 2 pipelines connecting the central grid here in China from Russia. And also we have pipeline from Central Asia. Central Asia, they also do a huge gas reserve. So the pipelines are being connected. And the other is from Myanmar. They also have a pipeline connecting to our central grid here in China. So these 3 sources, pipe gas, they are nowhere near Middle East, and so we should be safe. And of course, there are some LNG imports, right, from Qatar, and as I understand it, it accounts for approximately 10% of the total natural gas and LNG from import. So that may affect a little bit, but the gas consumption, I can see that because central government, in particular, they will have more renewable. Renewable basically is help to balance renewable energy and natural gas. We, Hong Kong China Gas, we already started this renewable business 5 years ago, and we have 400,000 commercial industrial customers. In particular, those industrial customers, the rooftop basically empty. We lay PV panels to supply green electricity to them. So help them to reduce carbon emission. So we supply natural gas to them to reduce their used to be heavy carbon emission energy, and then the renewable PV panels to help them reduce the carbon emission. So we are helping China to achieve the 2030 and 2060 target.
Peter, it's great to have you. Thank you so much for coming and telling us really how a business like yours is really dealing with, of course, all these headlines as well. Peter Wong there, Managing Director of Towngas. We do have some headlines that are crossing when it comes to BMW in China. Now, we are hearing that the company is going to be recalling cars in China over fire risk. This is a statement that's coming through from the SMMR, the State Administration for Market Regulation. So in terms of how many that we're talking about, Dave, they're talking about 134,022 cars in China. That's all we know so far. But the fire risk, that's quite interesting.
Yeah, let me just jump in because there has been, there's a new number that's actually now out. So it is 179,527 cars in China on the back of the same reason that Yvonne just laid out there for you guys. Anyway, once we have more information on the story, we will bring it to you. Plus, of course, all the latest moves across these markets. This is an ongoing story. So we'll take a short break, and we will see you on the other side of it. All right, that did not last very long. U.S. following the relief rally that by the way, we're still feeling in cash markets in the Asia Pacific, futures in the U.S., and looking at the European session going into Tuesday have now actually gained some momentum to the downside. We were down as much as 1%, I believe. On the Stocks 50 contract, we paired a few points, but yes, I think the message is risk aversion is the overlay of risk aversion is somewhat back in the last hour or so.
Yeah, still a lot of uncertainty when it comes to where we are in this Iran situation. When you have some lawmakers there talking about, there are no negotiations that are going with the U.S. at the moment. So there you go. You are seeing risk sentiment getting sapped a little bit. Let's check in some other world news this morning. President Trump's energy chief has downplayed the impact the war with Iran is having on oil prices. Energy Secretary Chris Wright was speaking at the CERAWeek event in Houston about the impact of the effective closure of the Strait of Hormuz.
Stu, prices went up to send signals to everyone that can produce more, please produce more. The prices have not risen high enough yet to drive meaningful demand destruction.
New York's LaGuardia Airport has reopened with reduced capacity after an Air Canada Express plane collided with a fire truck on a runway late Sunday night, killing both pilots. Recordings reveal an air traffic controller ordering the truck to stop just before the impact with the plane, which was traveling at more than 200 kilometers an hour. 76 people were aboard the aircraft, with more than 40 needing hospital treatment.
LaGuardia is a very well-staffed airport. We're a couple controllers short in total, but it is a well-staffed airport. Again, 33 certified controllers that operate out of the tower here at LaGuardia.
All right, a look at the dollar, which I think is a very good, at least at this point in time, an accurate representation of risk assets, risk appetite. To be more specific, this heads north. The appetite goes down. And yes, we are seeing the dollar again pick up, given, I think, just I would like to say complication, but the confusion, I think, is perhaps more apt description of what markets are looking to take away from the recent commentary coming through from both sides of the war, including the White House and, of course, what we're hearing from the Iranians and within the Middle East. The Journal report, of course, on the Saudis are near a decision whether to join in on what's happening there. CSI 300 is now flat. Hang Seng is down over just over 1% right now. Plenty more ahead. This is Bloomberg.
Welcome back to the China Show. When it comes to this risk rally, it is starting to fade a bit. Just to say, we're still up about 0.9% for the Hang Seng, but when it comes to what Euro futures, what U.S. futures are pointing to, they are all in negative territory here today. So there is, yes, a bit of relief that President Trump has pushed back his threat of attacking Iran power plants, but we're still deciphering whether there is real material, meaningful progress when it comes to reaching a deal. And perhaps that's why you're seeing that little bit of doubt across investors' minds right now.
Absolutely. In public, it's somewhat clearer now, I think, is the good thing as far as what the U.S. president has said. In public, on the other side, it's quite clear, though, that it doesn't seem that they are open to that suggestion. Now, we don't know, of course, what's taking place, if any, as far as back channels go. Markets are taking this, and they're splitting the difference between the two when you look at how risk assets are now trading and the direction. In fact, have a look at where we are in the Nikkei topics. Kospi, the Taiwan markets, about an hour into that session. Indonesia, by the way, is still shut, so that market should be coming online now. It's not for today. 1.5% to the upside on the topics index. We're looking at Brent prices. Coal is also in focus. I think this is the Dalian contract, up still 2%. Brent is now up by about 3.5%, so that should be at or near session highs. And gold, following that, of course, it took out that key support level yesterday, does remain below that key threshold. The dollar is back. I think when you look at the dollar against some EM currencies, by the way, in case you missed that, EM strategies, as far as the carry strategies, have been wiped out for the year. We are set for the worst month on EM carry going back to 2022. And the bond markets, we're looking at the 10s coming up on your screens. And yeah, there we go, as far as the Aussie yields are concerned. So we're looking at, again, an extension of the rally we had overnight, although the Treasury market is now dancing the opposite way.
Yeah, and what we heard from the IEA, talking about the disruptions that we could be seeing, where Asia is at the forefront of this current energy crisis, and we're seeing that play out now across the region, right? What we've heard in the last few hours or so, the Philippines, their energy officials say they have 45 days of supply as of March 20th here. So we're talking about 40 days moving forward. We just talked to the likes of Towngas as well, saying, look, when it comes to some of these, contracts that they have, the amount of supplies that they have, maybe it's a matter of just 3 or 4 months that they can kind of hold on to this. Japan, Katayama has also been talking about they're going to be taking measures on all fronts. So they are trying to reassure markets here that, contingency plans are being played out. Korea, though, interesting enough, we got in the last couple minutes, right? When it comes to how they're going to be looking at alternatives, right? So they're raising renewable energy, ESS installation to cut LNG. So they are finding ways to seek for other sources here right now. But what does that mean for the whole chip AI build out? Certainly is going to be a key question too.
Yeah, and that came up right with helium a few weeks back. In as far as that was also apparently needed, right? Not apparently, it is needed. We just found out. Most of us just found out about that angle to that story. Meanwhile, of course, there's also the mainland China angle, and Towngas also helped us elucidate. Just to give you a big
using
word.
That word again.
Yeah,
so complicated.
I mean, we have to use every window we get. And I think the message he sent earlier was quite interesting because he said China's not worried about this because they have been. It pays when you fix the roof on a sunny day, right? So they've been able to stock up on these supplies. Again, to the story that Winnie has talked about, that China is not a very exciting equity market story, but that's what you need right now, given the complexity out there. Let me just add to that.
Goldman did raise their Brent forecast yesterday,
to 85, right? And I think we spoke with the head of global commodities at Goldman Sachs just to underscore the reasoning behind that upgrade in Brent prices. Have a listen.
We do think that the largest oil supply shock ever is going to lead to two structural changes. One, faster strategic stockpiling by governments as they're going to deplete SPRs this year and realize that in this uncertain supply environment, you probably want to have a higher target level for your SPRs. And second, I think the recognition of the risks associated with the high concentration of production and spare capacity is probably going to lead to the pricing in of a security premium in longer dated prices.
Let's get to our politics editor, Laura Davison. She's been looking through all these headlines. It seems like markets are losing a little bit of momentum already, given some of these doubts of maybe possible de-escalation. What's the latest now?
So there's a whole game of telephone happening here, and it's been very unclear for the past 12 hours or so about who's talking to who and what exactly the status of these talks are. Trump came out and said that there were big points of agreement and that there were substantial talks happening. Pretty clear that that's not what's happening. Iran has really pushed back on that, saying, look, that we are not negotiating. It's there's been signs that there may be some sort of, kind of back of the classroom notes being passed forward, back and forth with sort of some preliminary talks. U.S. officials have said that things, privately have cast these as, much more early stage negotiations. There's some concern among U.S. allies that, the U.S. thought that when the U.S. said it was ready to talk, that Iran would come to the table. Not at all clear that is in the pictures here. And this is what we're seeing. Trump now set a 5-day deadline here for some sort of talks. He needs to come up with some sort of momentum here. Unclear that that's going to happen either. So this, there was a lot of optimism when Trump came out and said that he was going to be backing off this demand to strike energy sites. But now he's got to find another off-ramp, with just a couple days to go.
Has the market made him similar to 11 months ago when the market acted up and he backed off on tariffs? Has the market made him back down this time? Or I think the other thing I want to point out is a few weeks ago, it did seem he was backing off. And then we had the strikes a few days after. He said that the negotiations were going well. 2 days after, Israel struck Iran. Which of the two is it?
There are really two schools of thoughts here. One, that this is just a head fake and that he's using sort of allowing the tensions to fuse here a little bit to then come in with an attack, where there are signs that the U.S. is sending more Marines to the area. So there's not, there's some kind of heft to that argument. The other here is that Trump is attuned to the markets, particularly when they get really bad, and he likes to tow it up to that line and then bring it back. This feels very similar to what we saw in that post-Liberation Day pullback that you saw, kind of every single warning sign in the market, red up on all of the screens, and where you saw him come out yesterday at early in the morning before markets wanting to ease those concerns.
Yeah, that taco trade that seems to be coming back. There was this line from the Journal about the Saudis and maybe even the UAE is now considering or taking steps to join in on this war. Would that be a significant escalation then of the conflict?
It would be sort of a marginal escalation. I mean, one, you have both the Gulf allies who are getting mad because their sights are are getting hit. Iran keeps striking them. Also, if they see this as a way to potentially end this war sooner, give the U.S. a little bit more of an advantage, allowing them to use their airbase, their airspaces, other infrastructure in the region, it could help. So that may be a sign that they see, at least the potential for, an end game here within the coming days or weeks.
Laura Davison there, our Bloomberg politics editor. On the macro side of things, I think Yvonne and I were talking about this time yesterday. BofA they upgraded their forecast on Chinese inflation.
Yeah.
They've pushed back expectations of rate cuts. What rate cuts when you look across the board? The Fed is now priced to hike. Goldman Sachs, there's a story out at the terminal today. Goldman has axed rate cut forecasts for Indonesia. They're also flagging rate hikes for India and how the macro story has been upended. With that in mind, let's see what this means for markets across assets. Liao is here with us, Director of Derivatives Market Intelligence at CBOE. Very nice to see you and good morning. Why don't we start with the macro question? How have things changed?
Pleasure to be here. Yes, macro landscape has really shifted significantly from the beginning of the year, right? In January, we were still trading this Goldilocks consensus, steady growth and the inflation coming down. Fed is going to cut twice. And then into February, market shifted to AI-related disruption and the rotation from software to hardware. And then into March, we're seeing this energy shock-led repricing of macro risk across the board. And at the same time, rising inflation expectation and the weakening labor markets data is causing a sort of a worsening of growth and inflation mix that brought back the stagflation fears in the markets. And we are seeing the repricing of Fed rates, and we're seeing tightening of financial conditions and the broad sell-off of risk assets across the board. So not a boring start of the year so far.
No, to say the least. It's interesting because what if we saw some sort of ceasefire, de-escalation now? Are we still going to see some of the long-term economic spillover impact, right? I mean, the hit to growth. I mean, it seems to be the market is changing from whether this is just inflationary to also impacting growth moving forward. In some ways, do you think markets are still underestimating the real potential impact this really could have, given this energy shock?
Right. If we look at the signals from the options markets, right, for example, the clearest signal we are getting is from the oil price, the options markets. Although oil pullback, I mean, oil prices have been swings due to the headlines. But if you look at longer dated oil options, the skew, so the price of the calls relative to the price of the puts still close to the record high levels if you look at the longer dated, like 6 months to 1 year down the road. So that's signaling that oil markets is actually pricing for longer oil price disruptions. So and also interestingly, another signal I like to highlight from the options market is gold. How gold has been trading, right?
Yeah, what's happening there?
Yes, it's really confusing because the conventional wisdom.
They lied to us.
Yeah, exactly.
They lied to us. They said gold was a haven. What happened there?
Exactly. We were told gold is a safe haven and also gold is an inflation hedge, but it didn't work this time, and it didn't work last time back in 2022 either. So what is happening? Gold's correlation with equities has been turning negative starting from last year already. So this positive correlation basically means gold is now trading like a risk asset.
Yeah.
So very interestingly, if we look at how gold vol has been trading since the start of the war, for the first 2 weeks, gold vol actually dropped. Why? Because gold vol was beat up prior to the Iran attack. Markets were chasing momentum. They were buying calls to beat up the gold prices as the momentum was very strong upwards. But since then, gold prices dropped since the start of the war. Therefore, the gold buying, the chasing on the momentum is weakened. So we saw the gold vol actually dropped. But the last couple of days, because the gold price continued to drop, so we are actually seeing the vol price of the gold spikes because the puts are coming back. So now people completely flipped from calls to puts on the gold. So the gold vol remains elevated, but what's driving that is completely flipped from calls to puts.
And do you get a sense, because of positioning, short term, the likely direction of gold could be still more down than up?
From the positioning, it's signaling that way, yes, because the puts now the gold basically is trading inverted, right? The skew.
Right.
So the puts, it's back to skew is back to steepen again. I think the skew is about trading as the steepest since a year ago, and that's after it's been persistently inverted for a year. So the market is signaling that maybe the downside has further to run.
If I'm seeing correlations break down everywhere, I mean, the 60-40 sort of playbook, that seems like I need to toss this old playbook aside here right now. What is the new playbook then to ride out this volatility?
Exactly, that's a great question. In this sort of stagflationary environments, right, like your traditional safe haven like bonds and golds just didn't seem to work. So so that's why option-based strategies become very interesting, very relevant in this type of environment, because it offers alternative diversification and source of income for you. These days, people can access these sort of option-based ETFs strategies through just via ETF ticker. So made the access actually much easier than previously. You have to replicate through calls.
Okay, so income is king. It's just to clarify what the strategy is.
Well, from what we are seeing at this. From our seats at the CBOE, we're seeing retail investors, for example, this time their positioning is much more cautious into beginning of this year compared to their positioning compared to 2022. We are seeing that there's much less call buying and more call overwriting to generate income. So retail investors, they're getting more and more sophisticated in managing risk. So they're using options not just to hedge your risk or especially the directional view. They actually use options to systematically shorting options to generate income with, of course, defined risks. Yeah.
Liao, it was great to have you. Come back. Liao, the director of the derivatives market intelligence at CBOE, joining us here in our Hong Kong studios. And still ahead on the China show, we talked to Shanghai-based U.S.-listed procurement service platform ZKH. The CFO Max Lai joins us exclusively to discuss the impact on this Iran war, their AI plans, and their return to quarterly profitability. This is Bloomberg.
Right. The other story we're tracking is what came out of Apollo. Yeah, this is on private credit. Stock in after hours fell about 2.6. The company talking about what they're planning around redemptions. It's one of, well, at least from one of its largest non-traded private credit funds. This is for retail investors. Certainly the latest asset manager to forced to grapple with a surge in give me my money.
Yeah, let's bring in our Asia credit editor, Finbar Flynn, to at least give us some answers. Finbar, we have another private credit fund, this time Apollo itself, capping withdrawals. Did we learn anything new?
Good morning. Yes, I think the Apollo announcement was quite interesting. We saw the redemptions were 11.2%. And I've spoken to some people around this, and this is actually a lagging indicator more than a leading indicator, because these deadlines for getting your money back went up, a couple of months back. So I imagine what retail investors are thinking now, because we've really seen the concerns about private credit emerge in the last couple of months. Although I must admit that at the end of last year, we'd already heard murmurings around, software companies. That's the biggest bet that private credit has made. A quarter to maybe 30% of their money is in software, and we all know that that's getting hit by AI. We don't know what's going to happen, so they're the concerns.
Well, the other side, Finbar, is are there signs that have emerged about all these concerns maybe starting to settle down?
I think we're a long way away from things settling down. I think if you talk to other investors outside of private credit, they say there will be an opportunity at some point, but we're not anywhere near that point yet. That's because they point to these loans. A lot of these loans were on companies like software companies, as I mentioned, that were taken private a couple of years ago at valuations twice, 3 times what they are worth now, and the loans backing them, they're worth a lot less. So there's going to be less people willing to take up these loans when they need to get rid of them. So I think this is going to be with us for a couple of quarters, to be honest.
Yeah, and obviously there's concerns about the impact this could have on the banks, whether this is something that is going to lead to something that hits the financial system. I mean, what are some of the main risks that you're looking out for now?
So I looked into this, and we had a great story last year, and the headline itself is a bit worrying. It says that 1/3 of U.S. insurance companies' assets are in private credit. And you would ask, how can that be possible? But it's all got to do with this interconnectedness, because the PE companies who bought these companies are also lending to these companies, but they also bought insurance companies. And these insurance companies are putting an awful lot of their assets into private credit. So you've got this, this web of interconnectedness that, to be honest, that regulators haven't focused on that much. We know that banks have an awful lot of regulation, but this private credit doesn't.
All right, Finbar. Thank you. Keep us updated there. Finbar Flynn, our Asia credit editor, joining us out of Tokyo. And private credit is certainly the big thing for our big take here today. We're focusing a little bit more on this firm, Cliffwater. Among the companies facing concerns, investors rush to withdraw their money amid concerns in the sector here. They've also been a big giant in the private credit industry, investing in other firms, creating a fund of private credit funds as well. So yes, make sure to check it out here at Bloomberg.com.
Right, welcome back. It's actually a big week in Hong Kong. In fact, when you look at the events on the left side, you have BofA, you have Wealth for Good that is today, you have the Family Office Summit. It's an opportune time really and this came from our interview earlier on with Christopher Hui, to underscore the relative stable hub that we're looking at here as far as this wealth conversation. It's the 4th iteration, by the way, of Wealth for Good. We have a piece that just highlights this from a talent perspective, and this war for wealth managers, and seeing really substantial increases in packages because of just this. This
20%?
In some cases, yeah, to manage people's the wealth of folks out there. Anyway, with that in mind, we did speak with Christopher Hui earlier on this. So have a listen.
Hong Kong as a financial center, we've been going all out in terms of reforming our capital market, at the same time try to draw international capital here. As you can see, like for example, last year we have 119 listings in Hong Kong, and also the proceeds that we get at IPO is a record number. And at the same time, what you see is, apart from capital formation on the wealth management side, we are also seeing that increasingly more people are interested in family offices in Hong Kong. And that's why this week we have the Wealth for Good Summit here.
And what's the message this year?
As you said, I think we are in a very complex world, but that said, Hong Kong as a safe, stable, and also sophisticated financial center is always ready to serve the world. Like, for example, apart from having the conference here today, we also have a series of reforms and measures to draw global capital. In fact, we are going to put together a bill for legislative approval to expand the tax concessions that we give to family offices and funds to include more asset classes like digital asset, precious metal, and also private credit. And at the same time, we are also trying to enhance our role as a wealth management center by leveraging the overall need of corporates for internal cash management. So that's why we are going to revamp our law and also our regime to enhance our tax concession to given for these treasury centers in Hong Kong. in such a way that for corporates, if they want to manage their cash internally through Hong Kong, we have a more favorable regime for them.
I need to ask the connection and what we're seeing in as far as the risks and opportunities because of what's happening in the Middle East. And we know, of course, we've talked about this a lot, that Hong Kong has built this Middle East corridor. In what ways do you think Hong Kong is prepared to receive some of the flows that could be getting out that part of the world?
Hong Kong is always ready, despite what's happening around us. If you look at the reforms that I said into wealth management, at the same time reforms that we have to our capital market by lowering the threshold for weighted voting right, and also at the same time to expand the definition of technology companies to be listed here. We are always on the drive in terms of making our market more competitive. That's number one. And number two, if you look at the recent number, right now, for example, through our Invest Hong Kong, we have around 156 family offices who have already indicated their plan to set up or expand in Hong Kong. And also this time, when we have the Wealth Focus Summit for the fourth time, we are also welcoming more guests from the Middle East. Actually, there's one from the Morocco family offices that already indicated and also confirmed their interest to expand here. So I think all these are actually showcasing our role as a financial center and also being a safe, stable, and also sophisticated one in this complex world.
I see. And this group from the Middle East, they're still scheduled to come?
Yes. Yeah.
Okay. Yeah. I understand. Have we seen any early signs that a transfer of some wealth because of what's happening there to Hong Kong? What early conversations are you having?
If you recall, the chief executive led a delegation to the Middle East some time ago. And at the same time, as a follow-up, my bureau and also Invest Hong Kong has been closely monitoring the developments throughout with a view to identifying needs of these companies, corporates, and also individuals to see how Hong Kong can serve them better. And again, that's context. That's why we have increasing interest from the Eastern family offices to come. And it's also being seen from the turnout from this year's Wealth Focus Summit.
11:29 a.m. in Tokyo. Japanese markets are heading to that lunch break in just a moment. And yeah, you're talking about when it comes to the relief rally, we're coming off the initial sort of momentum here. So Nikkei 225, we're still seeing gains about 0.7%. Topics is also 1.5% to the upside here. So at least there's still some green. 158 levels for dollar yen. And of course, we did get that CPI number that came out. It was on the softer side, but some economists say, look, that shouldn't deter the BOJ from hiking next month. That certainly is, maybe getting more consensus now.
It's coming.
It could be.
Yeah, it's coming.
Maybe Iran has really pushed that. Yeah.
And if others are going to hike too, that's also something for the BOJ to consider as far as where real rates should be, right? The yen weakness and the fact that you don't have positive real rates there, and others are hiking, that's going to exacerbate that issue. Anyway, that's just a further complication too. Another thing to consider, Asia, because Japan is doing this, Asia is also doing this. There we go, 1.2% to the upside. The counterbalance is when you look ahead to Europe and the U.S., and U.S. futures, as you can see, are now down. So it's looking like we're going to hit some version of a wall in the Asian session, at least not for today, but likely, of course, as we make our way into the thick of Tuesday. And if you want to understand why, or not understand why because they're confusing statements, you're going to see this graphic coming up. This is effectively the big headlines we've heard over the last few hours or so, and try and make a consistent, just try and string out a consistent message from this. It's going to be extremely difficult. But yeah, like a lot of lines coming through from very consequential sources and newsrooms, just painting a very different picture, depends who you ask, I guess.
Yeah, and is this something that Trump is no longer able to control the narrative of where this war goes moving forward? If you're talking about the likes of the Saudis, the UAE, stepping up or at least close to that decision on whether to join on these attacks on Iran. So certainly that certainly leads to maybe a moderate sort of escalation of the conflict now. Maybe that's why you're seeing U.S. futures are still in negative territory during this Asia session. Let's talk a bit more about the earnings side of things. Yeah. And certainly there's got to talk about what the potential Iran impact has on companies, supply chains, and the like. And we're looking at this particular company, ZKH Group, a Chinese e-commerce platform specializing in tools, supplies, and maintenance, repair, and operations. Simply speak, MRO work. It's a U.S. listed stock. It's fluctuated over the past week, dropping more than 28% after earnings before recovering some of the losses, and then jumping another 8% on Monday.
Yeah. In fact, I think it was one of the biggest gainers on the Golden Dragon Index over overnight, up some 8%. Joining us exclusively to talk us through the results and what this means perhaps for the broad direction of travel moving forward. Joining us here on set, Max Lai, exclusive with us here, the group's CFO. Very nice to see you.
Nice to see you.
Good set of results so far.
Yes.
Positive, back to positive.
Yeah, make positive.
What do you think drove that, and do you think is that something we can and should expect from the company?
Yes. Before I give highlights about our Q4 results, maybe I can give 1 or 2 minutes to introduce our companies.
Sure, go ahead.
ZKH is a leading MRO procurement service company in China, and MRO stands for maintenance, operations, and repairs. They are the materials used for maintenance, repair, and operations for the factories, but they do not constitute final products. Our customers are industrial enterprises in China, including multinational corporations such as Tesla, and also leading private enterprises such as BYD, and also state-owned enterprises and SME customers. Traditionally, these customers buy products from local hardwares, distributors, and agents. Now they have a better choice to procure these products from our platforms. So this is the background about our company. In the fourth quarter of 2025, we delivered accelerated top-line growth, and also improved operational efficiency, and also the return to the profitability in the fourth quarter. This reflects our improvements in our core business operations, and also the growing benefits from the operation optimization and business optimization we implemented over the past several quarters. In the fourth quarter of 2025, our GMV grew by 8.7% year over year, and also 11.3% sequentially, up to 2.9 billion, and also our revenues also grew by high single digits. This reflects supported by our continued expanding customer base, and also as well as enhanced product offerings, and also the last mile delivery capabilities.
I was going to get your take on just the news. I mean, this Iran conflicts have basically upended a lot of global supply chains up there, and when it comes to manufacturers that you do, we talk about some of the big customers that you have. They're definitely facing higher raw material prices, higher freight fees right now. Are you seeing any of that across your platforms right now? Due to recent Middle East conflicts, we do see there is some commodities prices increase movement, and we do see some of our products, such as the lubricant, such as adhesive, and plastic gloves, the price are increasing. But to my understanding, to our analysis, the impact is very limited and manageable. This is because we have over 23 million SKU, and also
what's SKU?
SKU products. Products. We have over 23 million products for the customers to choose. There is no single product categories accounts for more than 5% of our GMV or the revenues. So it is the concentration is very low, and also we have a very diversified supplier profile. At the same time, we are doing very good in private label products, and also SMB customers. They usually have a higher margin. So the expanding the contribution from our private label, and also expanding contribution from our SMB customers will offset partially the negative impact of the commodity price increases.
So folks effectively have more options, and I guess you're diversifying, of course, the base of revenues. How does that go into? Do you have as much visibility this year compared to the start of the year?
Yes, sure.
In terms of your revenue, have any of those plans got upended in some way, or is it still stable as it goes?
First of all, the total addressable market size in ML products, ML procurement services industry in China is very huge, about RMB 3 to 4 trillion. And also the online penetration rate is still very low. It's still in the early stage. So there is still a lot of room for us to make
What's your
customers.
market share now? I'm curious.
The market share is still very low.
Okay.
It's in single digit. But what I want to say is that there is plenty of room for us to grow.
Sure.
Our strategy is very clear. Firstly, we will cover and to increase the wallet share of KA, key account customers, by covering more of their factories and also do more cross-selling. Secondly, we will expand our SME customer coverage. There are about 3 million SME enterprises, manufacturing enterprises in China. There's still plenty of room for us to expand to cover the SME customers.
I know you also have plans to expand overseas, and this certainly is a trend that we're seeing across a lot of Chinese companies going global. Can you tell us a bit more about those plans, and does this Iran conflict affect the pace of that expansion in any way?
Going global is our key strategy over the past 2 years. We started to go overseas starting from the 2025. The rationale behind the international expansion is that China MRO not only serve the domestic market in China but also serve the globally, because most of these products the US will not produce them and the Europe will not produce them. Most of them will import China ML products to the local markets to sell. And also over the past 2 or 3 years, a lot of Chinese companies moved to the overseas to build their manufacturing factories outside.
So what markets are you looking at now?
We are now looking for US market. We have already established a subsidiary and also local team in US, and the registered customer number reaches more than 9,000, and also the SKU we sell in the US is more than 700 SKU. And another market is the Southeast Asia and also South America, because a lot of Chinese manufacturers go over there to set up their factories. The local factories also need the MRO procurement services. So we consolidate the demand in China and then shift the products to them, to the local factories.
How much top line growth are you expecting this year for the full year? And I have a follow-up to that too. So you're back to profits on a quarterly basis, but on a net basis for the entire year that you're still down. Correct me if I'm wrong, net loss. Does that turn also positive in 2026?
For the 2026, we are working on mid to high single digit YY growth in terms of GMV. And also for the gross margin, we will have a gradual increase in the gross margin, and also the operating expenses ratio will continue to improve in 2026. That means in 2026 we are working on a meaningful full year profit.
Given the geopolitics, obviously, you are a U.S. listed Chinese company. I'm just wondering, there was a time when people talked about this homecoming, right? Coming back to list in Hong Kong or the mainland. I think that was initial plans for you. Is that still the case for you guys?
This is still the case for us because we see that a lot of very favorable positive policies issued by the Stock Exchange of Hong Kong and also CSRC give a green channel for the U.S. listed companies go back to Hong Kong. We have been discussing with our investment bankers and also our legal counsels, and the IPO, the Hong Kong IPO proposal is on the table.
Okay.
So we are going to the exact timing will be to be decided.
Okay, so just to clarify, the proposal from the bankers are on the table, or have you filed an application with the exchange?
The proposal on the table from the I bankers and also legal counsels.
I see. Okay, so the pitch is there for you.
The pitch is in.
Okay.
Max,
the bankers are really on their game these days.
Max, it's good to have you. Thank you. Max
thank you.
There, CFO at ZKH Group. We got much more coming ahead. This is Bloomberg. All right, right, something that we're tracking here, this trade deal, of course, with the European Union, Australia, they agreed, of course, to that deal, wrapping up almost a decade of talks. And the two sides also signed a security and defense partnership for better cooperation on crisis management.
We're pleased to announce the signing of a new Australia-EU security and defence partnership. The partnership provides a framework to strengthen cooperation between Australia and our European friends so that we can best respond to pressing global challenges. It will bolster our collaboration on defence industry, maritime security, cyber security, countering terrorism and combating hybrid threats such as disinformation. And it shows our shared commitment to global peace and security, including reaffirming our steadfast support for Ukraine in the face of Russia's illegal full-scale invasion.
Let's bring in James Mager, our Australia economy and government reporter, joining us now. So 10 years in the making, this trade deal, how significant is it?
I mean, there's going to be some increase in trade, obviously, reduction in tariffs for European exports to Australia, for cheese, chocolate, meat preparations, so salamis and things like that. Those are all going to go to zero. There's going to be some reduction in tariffs for Australian meat exports, Australian wine exports to Europe. So there will be an increase in trade. But I think really the bigger driving force today is not, the economic benefits that will accrue to industry from this. It's more the other two deals that there were 4 deals that signed today, but 2 of them, the most important was, as you mentioned, the deal on security and also the deal on critical minerals, so improving the critical minerals partnership that was announced a few years ago. And I think when you think about it, neither side, both sides had a lot of problems with the free trade deal, mostly because of agriculture. Australia's a big agricultural exporter. European countries are big agricultural exporters, but also have big domestic industries as well. And so those kind of clashes were sort of continuing, and that led to the talks to collapse in 2023. I think what's different now is that Europe's both political and trade and defense situation is so much more serious than it was a few years ago with the war in Ukraine continuing. Donald Trump saying he's going to, indicating he wants to pull out of NATO and not support Ukraine, and the rise of China and what China has done with critical minerals export controls. I think those things have sort of focused minds on what's really important. And in the end, what was really important was not getting another 10,000 or 20,000 tons worth of Australian beef exports to Europe. What was really important was getting some kind of trade deal, but also be able to cooperate better on critical minerals so that Australia can supply more rare earths to European industry, so that the two sides can collaborate better on security policy, on dealing with security challenges in the Middle East, in the Asia Pacific, but also in Europe. And so I think those are the things that have really pushed these deals over the line today, is that holistic kind of all-of-government view of what is the most important thing for Australia and Europe to agree at this time.
What's been the reaction so far, James?
I mean, the Australian reaction, or the reaction from Australian agriculture industry, has been incredibly angry. This was called the worst trade deal ever by the Australian Meat and Livestock Association, which is the people who grow farmers who grow beef or sheep or what have you. The dairy industry is very angry. The National Farmers Federation is very angry, and they had been indicating that unless there was a massive increase in the offer that was on the table in 2023, which Australia walked away from, they were not going to support this and they were going to impose this. But I think, again, I think you saw that when what Anthony Albanese said today and what Ursula von der Leyen said today, the things that were important, yes, trade is important, but these other things that were also very important, I think, is what has pushed the two countries to really just sit down and do this deal. And, is causing the Australian government to look past the anger of the farming community, that they're not getting a better deal, they're not getting more access to the European market.
Right. James, thank you so much. James Mager there in Tokyo for us. He's, of course, making his way back to Canberra, might make his way back, of course, to this part of the Asia-Pacific we'll see if and when, of course, President Xi and President Trump, of course, are set to meet. I mean, speaking of that, we did speak with the Eurasia Group on this planned summit between Chinese President Xi Jinping and U.S. President Donald Trump that could further stabilize the relationship. And the summit has yet to be rescheduled in terms of specific dates. That's after Donald Trump, of course, postponed that. But we did speak with Eurasia, the practice head for China, spoke to us in Beijing, of course, this week about perhaps the possible outcomes we should be expecting ahead of that summit.
The world needs the commitment to the summit, and that commitment remains. What everybody is looking for, what President Trump and President Xi have made a political commitment to with each other, is to stabilize this relationship over a period of time. I think the Korea deal was a very positive deal. I think the fact that the U.S. is hosting G20 and China is hosting APEC, which means their ministers are running around in each other's big cities all year long, and the two leaders will meet in these multilateral environments, is also very positive. So sooner or later, I believe Trump will come here. I believe Xi will reciprocate and go to the U.S. And all of this sends signals throughout the bureaucracies on each side that will lead them to work together better than they would have otherwise.
You've heard all the speculation that the PLA is watching this very closely, a decapitation strike in Venezuela, a decapitation strike in Tehran. Do you buy into that kind of speculation that they're looking at avenues to employ China, that is, towards Taiwan?
I'm sure that there's a lot of watching going on. I'm a former diplomat, and this is, governments do this, and they are probably learning their lessons, assessing capabilities. And of course, China is very focused on Taiwan. It is obviously preparing for any kinds of contingencies it might face. Whether this really changes their approach, I would say very unlikely.
Does a diversion of resources, military hardware, and attention by Washington to the Middle East, does that open the door for something to happen here with China and Taiwan?
I would say absolutely not. I believe that China has a policy towards Taiwan that is very deliberate. They will do things on their terms, when and how they want to. They're not going to be opportunistic about it. It is too risky. The other thing is, I don't believe China is looking for an opportunity to intervene militarily to deal with the Taiwan crisis. I think for now, they are still trying to work with non-military means, and for some years to come, it will probably look that way.
Yeah, there we go. That was Eurasia Group's David Meale speaking with Steve, of course, in Beijing just early this week. Right, we'll just leave you with a look at markets. Still up for the day, 1.5%, led by the Kospi index. So we're still doing okay on an index level. If you maybe get a hint of the nuance there, we'll tell you more of it in a couple of minutes. This is Bloomberg.
Checking some earnings and, of course, the reaction across these stock markets here today. Laopu Gold is certainly one big mover here. Rose in Hong Kong after its full-year revenue and profits surged, aided by soaring gold prices. The company's revenue jumped 221% in 2025 from a year ago. And the earnings reinforced Laopu's position as a leading high-end brand, even while Western luxury giants have grappled with sluggish demand in China. Stock is up some 8%. Henderson Land reported underlying profit for the full year that missed the average analyst estimate. Net income decreased 10% on year to 5.7 billion Hong Kong dollars. Final dividend per share was cut to 76 Hong Kong cents on economic uncertainties amid the Iran war. The company says its land bank will be sufficient to meet its development needs in the next few years. Wuxi AppTech shares posting strong gains after better than expected full-year net income. Profit of 19.2 billion yuan was more than double last year's, while revenue increased 16%. Following the earnings, CLSA and UBS lifted their target prices for the 8 shares. Morgan Stanley says expects further stock upside on strong leading indicators.
We're looking at the mining sector specifically today on the back of the rally in metals prices. It's playing out across most, not all, as you can see with Jiangxi Copper flat in the Hong Kong session, although you are getting, of course, some gains across Hongqiao, 3% in Hong Kong. Aussie miners, of course, AS51 MATL, no E in between index is the ticker for that sub-index there. That then goes into the broader commodity story with oil prices and the dollar, and we're at 104. So we are, we're at session highs right now, I believe, on Brent prices.
Yeah, we're initially down. We're resuming the advance already when it comes to oil. So that's where the angst is coming back. And certainly you're seeing that in U.S. and Euro futures. We could be waking up on this Tuesday morning on Wall Street, as well as in Europe there, with a little bit more doubt about where we are in this Iran war. So there you go. Asia's still up, though. But yes, this could be a telling signal what comes following today. That's it for us here on The China Show. Insight with Haz is next.